All right, let's jump right in. We're going to crack open a professional market report from the first week of September. And our goal is pretty simple. We want to figure out the, well, kind of weird logic that was driving the markets and what it all means for the week ahead.
So this is the big question, isn't it? It just feels totally backward. We saw data that showed hiring slowed down, unemployment went up a little bit, and the stock market cheered. It makes no sense on the surface. But this is the puzzle we're going to solve today, because figuring this out is the key to everything.
Okay, so first things first. What was the vibe on Wall Street? Well, the report tells us that the mood was actually pretty positive. Constructive. Even with some worries floating around, investors were generally feeling confident and looking for the upside.
And this, right here, this was the magic formula everyone was buying into. The thinking was that we're in this perfect little Goldilocks zone. The economy's growing, but not too hot. Inflation is coming down, and that beautiful combination has everyone hoping the Fed might actually start cutting interest rates soon. That's what creates a risk-on mood, basically a green light for investors to pile into stocks.
And you can literally see that optimism right here. This slide is a snapshot from the report's outlook table. Just look at that, it's a sea of green, all pointing up. From the US to Germany to Japan, the professional forecast was impulsive bullish. That's really just trader speak for, we're feeling really, really good about this.
All right, so let's get to the heart of the matter. How on earth does a weaker job market lead to all that bullish feeling we just saw? Well, it all comes down to this kind of counterintuitive chain reaction that's really in the driver's seat right now.
And here's how it works, step by step. First, you get the bad news, that softer jobs report. The market doesn't see a problem, it sees a solution. The thinking is, okay, if the job market is cooling, then wage pressure is easing up, and that means less fuel for inflation. Step 2, inflation fears go down. Which leads to step 3, if inflation isn't a huge threat, the Federal Reserve has room to start cutting interest rates. And that's the whole ballgame. The simple hope of lower rates is like rocket fuel for stocks.
Now, the report also pointed to a technical signal that backed all this up, something called a bull flattening yield curve. Don't get hung up on the jargon. All you need to know is that this is a signal from the bond market, often called the smart money, and it was basically screaming that big-time investors were also betting on Fed rate cuts coming soon. It was another sign that everyone was on the same page.
Now, this idea, this expectation for lower U.S. interest rates, it doesn't just stay in the stock market, oh no. It sends ripples out across the entire financial world. And one of the first places you see the impact is with the U.S. dollar.
And this is a really cool detail from the report. As everyone started betting on U.S. rate cuts, holding on to U.S. dollars became, well, a little less attractive. So what happened? Professional traders completely flipped the script. They went from a buy the dip strategy, where you buy the dollar when it's weak, to a sell the rally strategy, where you sell it every time it tries to get stronger.
And a weaker dollar isn't just a number on a screen. It has real-world effects. It's a nice little tailwind for big American companies that sell their products overseas. It makes things like gold, which is priced in dollars, more attractive, and it gives a lift to other major currencies. It's all part of that positive risk-on picture we've been talking about.
Okay, so let's shift gears a little bit into the more technical side of things. Because besides the economic data, a lot of analysts also look at chart patterns to try and read the market's mind. The report we're looking at uses a method called Elliott wave theory, which is one of many tools analysts use to try and map out where the market might be headed.
So what in the world is Elliott wave theory? Look, it's not a crystal ball, not at all. A better way to think about it is like a map of market psychology. The whole idea is that the collective mood of investors, swinging back and forth from fear to greed, creates these repetitive patterns or waves that you can see on a price chart.
And what this analysis suggests is that the S&P 500 is in what's known as Wave 5. In plain English, that's thought to be the final leg up in the current trend. Now, that doesn't mean the market is about to fall off a cliff tomorrow, but it does suggest that this rally might be in its later stages. It just adds a little note of caution to that otherwise sunny picture.
And that brings us to the main event. Because everything, and I mean everything we've talked about so far, the optimism, the rate cut hopes, the weak dollar, all of it is balanced on a knife's edge. It's all based on one big assumption. And this week, that assumption is about to get a serious reality check.
The whole bad news is good news story we've been telling, it only holds up if inflation keeps going down. And that makes the upcoming Consumer Price Index, the CPI report, the single most important event on the calendar. This one number could either pour gasoline on the fire or stop this rally dead in its tracks.
So really, it all boils down to two simple scenarios. Scenario 1, the CPI report comes in cool. Inflation is behaving itself. That would be a huge sigh of relief for the market and would confirm the whole story. But then there's scenario 2. We get a nasty surprise. The report comes in hot, suggesting inflation is stickier than we thought. That would reignite a lot of old fears.
And the market's reaction would be just as clear-cut. A cooler report probably means stocks go higher, the dollar goes lower, and the party continues. But a hot report, well, that would likely shatter those dreams of rate cuts, triggering a stock sell-off and a rebound in the dollar. For this one data point, the stakes really could not be higher.
So, there you have it. The whole market is pretty much holding its breath, waiting on one single number. We understand the logic, we see the potential ripple effects, and we know exactly what's on the line. The only question left is, will that number fan the flames of this rally, or will it be the bucket of cold water that puts it out? We are all about to find out.